Hello, everyone, and welcome to Jim Dalton's presentation on Run for the Roses, Navigating Year-End Trading. This is webinar 2 in a series of 5 where we meet on Monday mornings, 9 a.m. Eastern, for 1 hour or a little more to size up Monday, recap the end of the week, which is part of Sizing Up Monday, and the week ahead, and also to talk about the year as we wind it up. Questions are encouraged and welcomed. We only have an hour, so we can't guarantee anything with the questions, but we'd love to hear them. We are recording this webinar. We will post it. I'll have it on the site by about noontime Eastern at jdaltontrading.com. If you have not seen the message, please go to jdaltontrading.com, webinars, upcoming webinars, and download the report for this morning. We do not have an evening report to furnish to you, but that will be helpful to grab that report. It's also on the slides, so if you can't download it or anything like that, it is on the slides that Mr. Dalton will be presenting. And I think I've covered everything. Jim and I want to thank you all for being here. It's really a gift to have you share your time with us and give us the opportunity to share Jim's work with you. So we hope you enjoy it, and we thank you for being here. And I will turn it over to Jim. Good morning, Jim.
Good morning. I am here this morning. I was falling asleep last night and I heard my email go off, which I normally turn off, and I saw it was Brett Steenbarger sending an email to Julia offering condolences for my passing. Somebody had told him I had passed, but I will tell you that I am alive and well, and I hope that was very premature. All right. It's just a little unsettling. I find a little trouble to go to sleep. I said, I'm not closing my eyes. All right. What I want to start with this morning, this may look confusing, what is in front of you, but this is a recap of Friday, and it is probably the single best actual piece of information to convey what we mean when we talk about dealing with market-generated information as we begin to trade each day. It is also important because a lot of people, we have the intensives coming up. We have 2 intensives, one for January and one for April. We have a continuity program, and the continuity program is a special pricing for those that take both the January and the April intensive. The question comes up, what is different between the two? What is different is that each single day in the market provides you diversity of experience. There are no 2 days that are similar. They may be similar, but they're not going to be enough that you can just rotely trade them. Also, what has happened so far, the number of signups for what we call the continuity program, which includes both intensives, has been so strong that I'm adding additional service to it. And Julia has put this out in an announcement that between the 2 intensives, we were going to continue just the morning and daily report, the daily report and the morning report. I am now going to add at least 2 personalized chat comments a day on the live chat for the entire period once the first intensive starts, so that you really do get the continuity. And I think you'll see the importance of that as I go through the example that's right in front of us from Friday. The first I want to look at is, just so you can see, that the right down here at 2088.50 is the settle from Wednesday. To the right of that, and you see in the yellow box, is the electronic trade that took place from the time we settled on Wednesday until we reopened on Friday morning. Overnight inventory is measured from the settle of the previous day. So if the majority of trade takes place above that settle, then we would call overnight inventory as net long. The majority of trade between Wednesday's settle and Friday's opening was above the settle. So that means that overnight inventory is net long coming into Friday. About 65% of the time, we see that there is a counter auction or a correction of overnight inventory. Now, to understand and alter those odds a little bit, you have to understand the context. So the context coming into Friday was that the market had been up for some period of time. So it was very likely that inventory was already long from the daytime frame sessions. So then when we add additional inventory from overnight, then we have a situation where inventory is long across the board. The chances of getting that inventory counter auction probably exceed 65%. So that's the first thing as we get ready to open on Friday morning. If you go down and you'll see item number 2, which is the red line, which 2088.50, which I've already talked about, which was the settle from Friday. Notice that the market high in A period, the opening is right here. Number 3 marks the opening. The market opened and it rallied exactly to 2088.50. When a market goes to an exact reference, and markets, when it's day time frame or very short-term traders, they have a tendency to go to very visual references. When I see the A period print high at the opening from the settle from Wednesday, I am already in the mode that the chances are very good that we're going to come back and take that out. Doesn't have to be right away. Now, the markets are like any other business. They have to take care of current business first. The current business on Friday was that overnight inventory was long. We've already discussed that. So the market opens, rallies to exactly unchanged from Wednesday. I'm already alerted to the fact that that is what I would call a weak high. Now, it is classification. It is a good high because there's single prints. It is a weak high because it went exactly to a previous reference, and that previous reference was unchanged. So now I know that the odds of, I'm only talking about odds, not absolute, but the odds of continual downside throughout the day are relatively small unless we rally first. Okay, so now the market, we see the market go back down. The A period low goes to a single tick above the overnight low, and the overnight low is matching Wednesday's low. So now I have Friday's low early on at a tick above the overnight low and a tick above the Wednesday low. I now have a weak low. Yes, I got single prints in the A period, so I had a good low because it had single prints, but it was a weak low because it was just a single tick above Wednesday's low. The chances of that coming back through there are pretty good. So now at this point in time, when I'm getting ready to trade on Friday morning, I have a good high, but a weak high. I have a good low, but a weak low, and I have overnight inventory that is net long. Notice B period rallies to a single tick above the opening. This is Friday's opening where the green circle is. When I see that rally to a single tick below the opening, again, that tells me that that is short-term trader money selling at that level. And it tells me that because long-term money, if there was really long-term money in here or meaningful money, they're just not going to be that exacting. As I've said so many times, I ran an institutional desk. We had too much size to worry about that kind of exactness. Notice that C period comes up and trades exactly at the opening before it backs off. Now, that's a little later on. B period, A period, and B period, I didn't break this down any further, but B period and A period continually rallied just short of the opening. Finally, B period goes down and takes out the early morning low, the overnight low, and Wednesday's low. Now, let me recap. Before this is taken out, the market, if you were trading the market on Friday, you could see the day and short-term traders were selling every tiny little bounce. They were selling every tiny little bounce, selling it. They sold it initially at unchanged from Wednesday. They sold it every time it got back to a tick below or at the opening. That is very mechanical selling. But people were excited, and I'm looking, and I understand what was going on. This is part of understanding what is going on in the market. We were correcting for overnight inventory, and that was trapping an awful lot of short-term traders just over anxiously selling every rally. The market, once the market took this out, I was prepared at that time to go long on the market, which I did. And the reason being, the mechanical references up here, the tempo coming down here, and I could just see this frantic selling. The trap comes down here, and the market accelerates when it gets the stops below this level. So at that point in time, that was all that was going on. Overnight inventory has been corrected. We have now probably gone from overnight inventory that was too long to daytime frame inventory that has gone too short because of the over anxiousness of selling every little rally in here. Now, let's turn it back to a little more mechanical. Coming back up, one of our signature trades is anytime we look outside of a range and come back in, that increases the odds that we're going to attempt to go to the opposite extreme of the range. Doesn't have to happen, but it's one of those alerts. Additionally, you can see we left an excess buying tail down here. So what did the market do then? The market rallied back up. C period goes exactly to the opening again. Traders were selling it. And at this point in time, there were people just anxious to sell it again. And I'm watching this, I'm saying, all we're having right now is a short covering rally. And then finally, you got the early shorts, the people that got too short early, and they took the market, and the rest of the day was short covering, and then it's just a small bounce. It was the slowest trading day of the year. But the key information in here is really understanding the people that you are competing against. Understanding that overnight inventory was net long. Understanding that overnight inventory is usually held, not always, but usually held by the weakest of hands. When the inventory is long and they don't get immediate pressure to the upside to reward them for being long, then you have a tendency to see the weaker hands that were long overnight in the process of being forced to sell. There are smarter traders out there in the U.S. that understand that they're trapped, and they will push the market lower. I've always said trading is an awful lot of a game. And the game is if you get them caught short, and you know it, you press it. Now, unfortunately, a lot of other people that didn't understand this got caught short. A lot of short-term traders got caught short. So that's really what was going on Friday. But it was market-generated information. We were using the week high. We were using the week low. It was a good high early. It was a good low because you had single prints. But you could feel the daytime frame traders getting trapped. Now, before we go on to today, we only have time for a couple of questions. But Julia, do you have a couple of questions I can discuss about what I have just handled?
No, we don't have any. I'm sure people might start typing now, but it's 9:15, so we have 15 minutes for today, and
okay.
But I don't have any questions here.
Okay, thank you. Okay, now What we're looking at now is this would be Friday, Wednesday, Thursday. I do not count Thursday. This is really electronic overnight trade. It was part of what we saw in the last slide. The way Window Trader does it, they count this as a day, and it's really not.
Jim, excuse me.
Yes.
Can you open your time templates, and I want to ask you to apply that blue template we made last night. So go to the folder, over to the right, the folder on the top bars there. Yeah.
Now, some of those didn't take. I'm going to stay right here.
Well, they're saved though, Jim. They will load.
Okay.
I'm kind of confusing. Please, okay, fine.
Please let me stay here. Okay. Now, on the right, the profile on the right is the overnight trade from last night. Now, it's unfortunate it's in the same colors. It's in the same colors, but it is the overnight trade. So now, this was Friday's high. This is the settle from Friday. So the majority of trade is short from overnight. Even though we're trading above it right now, the majority of trade is short.
Excuse me, could you mark the settle so people can see that, Jim? Please, thanks.
Okay, there's the settle, the red line. Now, there are going to be, even though electronic trade between Wednesday night and Friday morning traded above the highs from Wednesday, Tuesday, Monday, and the previous Friday, that overnight trade did take out any stops that were left in electronic stops that were left in the market. A lot of traders do not place their stops in the overnight market because they know the potential for that to happen. So there are still likely to be stops above the Friday, a week ago Friday, stops above Monday, stops above last Tuesday, stops above Wednesday, stops above Friday that have not yet been taken out. Some of them were taken out electronically. But what I'm looking at this morning, this is the 2100 level. The red line on the top is the 2100 level. That has kind of been the psychological level. Short-term traders have been selling just short of that psychological level. It happened also in the electronic trade between Thanksgiving and Friday, and we're back there again. Now, Friday was the lowest trading day of the year, so we don't have a lot of information. Lowest volume of the year, so we don't have a lot of information to go on this morning. We do know that overnight inventory is net short. We do know that prior to the opening, we are just above Friday's high. We know that we have a very prominent point of control from Friday, and I will mark that, and the markets have a high tendency to go back and revisit those levels. What I'm thinking this morning is I'm just surmising that there's an awful lot of traders out there that really want to trade on a concept. And the concept is, wow, historically, there's a Santa Claus rally, and that Santa Claus rally generally starts the day after Thanksgiving. So a lot of traders, I'm guessing, are buying the market in anticipation of a Santa Claus rally without taking any of the other information we're looking at here in effect. That's the very shortest term traders. Now, granted, the odds will show them that, the chances for a Santa Claus rally are pretty good, but that can be a real trap because when it doesn't happen, it can get relatively ugly. So what are we looking at today? We're going to look at all these highs going back to a week ago Friday. We're going to look at that high. We have a potential gap right now when the market opens in just 10 minutes. So the question is going to be, can we continue higher? And the real reference I have is the psychological 2100 level. That's what I'm really looking at this morning, the psychological 2100 level. I'm coming in here and I'm saying overnight inventory is short. I think the counter to that is that daytime inventory on Friday was probably long. So for right now, I don't have a lot of information to go on, and that's okay. We don't want to force a trade. Julia put the slides back up again, and something we talk about an awful lot. One of the things that gets daytime frame traders in a lot of trouble is over anxiousness to trade early. Oh my golly, if I don't trade right away, I may miss the best trades of the day. Once you have that feeling that if you don't trade early, you may miss the best trade, you are pretty well doomed. You probably should just go walk away from the market. The good trades are made in calmness. That doesn't mean that you don't have to make them in a hurry sometimes, but they're made in calmness, and you understand why you're doing the trade. If you're doing the trade because you're so afraid emotionally that you're going to miss the trade, some of these people will end up doing 2 or 3 trades in the first 5 or 10 minutes of the market, frantically trying to get the direction the market's going in. When that happens, you've probably used a lot of financial capital, and you've used, more importantly, a lot of psychological capital. So right now, when I'm looking at this market, I really have no bias for what I want to do, if anything, early this morning. So that's where I am right now. I'm going to watch and see how the market opens. I know overnight inventory is net short. I know I have the a week ago Friday at 2094.50. That is the most recent high traded during the time when the NYSE was open, and I know I have my 2100 psychological level up here. If I take the 2094.50 level being the top of the high of the recent trade, and I say this is my balance area high, then what I'm going to sit there and say, okay, balance trading rules are in play. The balance trading rules are, if I fail to reach this level, then the odds are I start rotating back down towards the lower end of that level. And that lower end of that level could go all the way down to, I've marked it at the 2065.25 level, which is the high of an upper distribution going back to the 17th.
FOMC day, I think.
Pardon?
FOMC
yeah, okay.
day.
Yes. And, you know, and it's just a little bit below a low from the 23rd or 24th. So, but my focus to begin with right now is going to be a series. It's going to be on the overnight high, which is pretty much equivalent to Friday's high. Okay. Let me, before we open, we've got a few minutes. Let me take a few questions.
Okay, great. Thank you, Jim. I remember from the last intensive that Jim would adjust his view of overnight inventory based on recent activity. And I think the implication is that we are now and have been trading above the settle from Friday. Do you have any extenuating circumstances to interpret overnight inventory today?
No, I already added the one extenuating circumstance, and I said earlier that inventory, short-term inventory, was probably long from Friday. So that was the extenuating circumstance, that I had a little bit of long inventory from Friday.
Long inventory, Jim, just to confirm, because you're not showing the overnight.
No, Friday's inventory.
Oh, it's long from the pit. Okay, yep,
so
from the shortened session.
Yes, so it's the shortened session. I'm going to believe that short-term inventory was long coming into the weekend. So that probably is a adjustment to the overnight.
Okay, great. Thank you. Thank you, Jim. What topics will Jim teach for his options trading methodology? Will you teach how to pick strike price and expiration and, you know, some targets, and how to manage the trade and hedge the trade as you do in the intensives? You know,
the way I trade options, and this is very important, you know, we do not use the Greeks. The Greeks are based on prices and volatility in most cases. As some of you know, that, you know, Fisher Black has passed on, but we used to meet quite often and discuss the pricing models, and I was really never in agreement. Of course, they've been adjusted many times over the years, and I really didn't know what it was that bothered me exactly, but I do know now. And we trade value, not price. So, but the option trading that I do is rarely take an overnight unhedged position home. For example, Friday, when the market, and this is, and we don't have time to go into this in any great depth, but Friday, as I already said, I was looking at Friday. We saw this discussed earlier, and I thought that we were getting liquidation from overnight inventory. We already said that the references being exactly at Wednesday's high, short side. So we had options that expired on Friday. So down at the when the market was down here below, just below Wednesday's low, I was looking at buying calls, and at that point in time, I was actually buying the 2090 calls. I paid very little for them, but that's the kind of thing that I will do. So it's not based on, pardon?
No, go ahead.
No, it's not based on the Greeks. It's based on, I think, that this was trading for pennies at the time. It was trading, I want to say, 50, 60 cents, and I thought it had a pretty good chance to get back up to the 90 and sell for $1 or $2, and it went back up. It went out at 20.90.50, so it went out 50 cents in the money, and it traded up in the $2 range. So I got out a little too early, but those are the kind of things that I will do with options. That's just one example because of an example from Friday. I never sell premium unless it's against a long position, but it's not. I don't take it overnight. I'm not worried about decay, and it's an awful lot of it is based on what I see in the market right now. Okay. 3 minutes to go, another couple questions.
Yes, but to answer her question specifically, yes, Jim will give strike prices. He's usually trading weekly options, and he will explain whether we're in the chat because we're not in an online session, or we'll be in an online session like we are going to be here in 2 minutes, where he's going to tell you the strike that he's looking at, why he's looking to buy calls or sell puts, and then, you know, as he puts on the quote spec option trade, and then when he comes in and hedges against it, whether he's selling futures against his long calls or he's buying futures against his long puts. Okay, but that will be addressed, and it's usually weekly options. The expiration doesn't factor in too much.
Okay, let me
you can call us on that. We have 2 minutes and other questions.
Let me clarify a little bit of what Julie said. It's not going to be that exacting. It's not going to be. When I'm down here today, I may sit there and say, because I don't know exactly when I'm going to pull the trigger. I may look down and say, I'm looking at the 2090 calls down here, and then.
Right. Yeah.
So it's not it's not I'm buying them right here at this thing. I'm looking at them right here. This is what I'm looking to do. Everyone's got a different risk tolerance than I do. Some people may buy them here. Other people may want to buy them once we get back into Wednesday's range. That's a personal choice. Okay. Right. 1 minute to go. So let me just recap.
One question. Okay.
Yes. Go ahead.
Do you give any importance to the fact that today is the last day of November? Last day of the month.
Not really, no. I will watch what the market does. The market may give importance to it, and I will try and read that from market-generated information. Right now, I'm focusing on the overnight activity. I'm looking at the overnight high. I'm looking at Friday's high. I'm looking to see how much confidence I have right off of the opening. And like I say, my guess is that we woke up this morning, a lot of traders were buying in anticipation of a year-end rally. So we did not get, here we are, we did not gap higher. There's the opening.
Can you mark the high of the day, Jim, of Friday, so they can use that as a fulcrum? We're obviously looking at that.
Okay. So here's unchanged. So the market opened a tick below unchanged and began to rally immediately. So right now.
Guys over there. Okay.
Pardon?
We have the firecracker effect highs you put in the morning report,
okay.
But it's hard to see.
Here's I was looking at. There's going to be highs from Friday, highs from Wednesday, highs from Tuesday, high from Monday, and stops above all these highs going back a week, even though they traded through it in the
overnight, yeah.
in the overnight sessions. Okay, so now we're looking to see the level of confidence. We opened, immediately went through unchanged, but really and we're back above, above Friday's high, but there's no real gusto here. Nobody, I mean, if we're going to go early, you probably are going to have a little more pizzazz than this. You see what they're coming down, and what are they looking at? They're looking at exactly unchanged. The market bounced off of exactly unchanged. See it trading there right above. See how mechanical that is? Okay, no real selling yet. They're buying it just a tick above unchanged. Okay, so we got the opening. Market went higher. We're above Friday's high again. Buyers were buying at a single tick above unchanged, not a sign of strength. If you really had any real strength in this market this morning, and that doesn't mean that they don't take it all day and go get stops up here, but if you had any real strength, you're not going to come back to a single tick above unchanged. If I'm running an institutional desk and I've got large orders, I can't try and be that exacting. Okay, so a couple times we've looked above Friday's high, come back in. Very narrow range in here, first 2 minutes only.
We're at the edge of range.
The edge of range. The overnight high is always a target. It's always a target.
And the overnight inventory is still in play, that the short inventory could be adjusted off the open.
That is absolutely correct.
We got a question here, Jim. Do you believe volume will be light today?
I don't worry about it. And it's not. I take it as it comes. I don't try and lean into the wind on those kind of things. Remember, it is the last day of the month. I don't know what kind of adjustments people may have to make. Mm-hmm. So right now, when I look at this market, there's the opening. We have not been back to the opening. Traded through unchanged. We came back to a single tick above unchanged. We are now dancing around near Friday's high again. That was originally 5 contract. It's now 43. Just feeling here that there's no real confidence in here so far. It's a very narrow range. You shouldn't feel any confidence either up or down. You may have personal biases, but there's nothing in the market is showing any real confidence in here.
Are you already thinking about value now?
I'm always thinking about value. I'm always thinking about value. So right now I'm sitting there saying, okay, well, the first thing I'm always thinking about value. The first thing what I was recording early was that they kept buying them a tick above unchanged. That is not a sign of strength. Even if the market rallies for the rest of the day, it is not something I'm going to participate in when I see what it takes to be a single tick above unchanged for the traders to buy it. And we saw that 4 or 5 times. Now we've come back to unchanged. Now we're back through it. Okay, so you see how that, when I'm talking about what are you looking at the market, I'm looking at those kind of references. I'm trying to see who's active in the market. And I was watching unchanged, and I'm saying there just doesn't feel like there's anything there. And I said, if there's anything on the upside, I'm not going to have any interest in it, at least not unless they come back. If they came back, which they have done, and taken this out, then if it fails, then I might change my mind. It's a continuous two-way auction process. So right now we have looked above Friday's high. We have come back into the range. The destination trade now is going to be down, looking to see if they can get to the point of control at the 2087.50 level from Friday. But the big thing takeaway for everybody watching this morning so far, at least in my opinion, was the fact that the market kept coming down to a tick above unchanged, and short-term traders were automatically buying it there. We saw that 4 or 5 times. That was an immediate alert to me that is not strength. That is not a sign of strength. That is a sign that there's weak hands getting long this market, not strong hands. Okay, now, anytime we look above a previous day's range and come back in, for a short-term trader, that is where you ought to go short. I mean, you got to have discipline because this is still not a high confidence market. Still not a high confidence market. But this is a very legitimate trade. We look above the high a couple of times. We come back in. That is a potential short-term trade. This is where, at this point in time, I would probably be looking at buying the 2080 puts that expire on Friday. Now, it's very hard for me to do that when we're talking right here in seminar before, but I would have these up. I would have the 2080s up. And once we failed and came back in, that would be, so one of the ways that I might play this. Now, once I buy those, I can do several things. I can just let it go and sell them at a profit. Or if the market falters down here, I might go long some futures against them as a hedge. And it's a way for me to get a little bit more leverage. But right now, there was the opening was a tick above unchanged. We looked above unchanged. We rallied up. We kept coming back to this 4 or 5 times. Now we finally broke through it. Now we're getting a little more liquidation, a little more confidence on the downside. We said the destination trade is 2087.50, which was the prominent point of control from Friday. But still record, there is no real sense of confidence in here. The one trade that I have seen, when I say early on, don't be too anxious to trade early on. This is a legitimate trade. When you looked above it and came back in, I don't classify that as somebody that's trading right off the opening. You traded based on a reference. So this could have happened 30 minutes later or it could have happened 5 minutes later. That is, doing that short is different than being overly anxious to trade in the morning. Okay, so now the market's coming down. We're looking at the prominent point of control from Friday. We're going to see if we get any real volume in here coming in. When you look, this is white. The heaviest volume is up here, and now you've got some liquidation going on in the market. You can see how it's a single tick above the prominent point of control from Friday. When it goes to a single tick, who do you think's trading it down there? Again, the longer term, more serious money, they have no idea what the point of control is or the fairest price. It's far from them. This is, when you come to a level like this, that is a very visual level that people can see on their profiles, they can see on their charts, okay? You saw it bounce a little bit through there. Now we've taken that out, okay? So if you did a short up here, it's still in motion. Your destination trade now is a combination of the overnight low and the next thing would be the overnight low and Friday's low. Somebody asked about value. This doesn't show real well, but this is top of value is there, bottom of value is there. It doesn't show very well. We'll improve as we go on. So right now we're trading at the lower end of value from Friday. Right now we are still within Friday's range. Even though there's a lot of single prints, we got some liquidation. I don't sense any real high confidence selling in here. Remember, I was watching this volume. The heavy volume is here. We get volume coming down here, but we're not getting really heavy volume. I said probably short-term inventory was probably long coming into today from Friday, but right now we're still within Friday's range. So I'm seeing one trade this morning, and that trade was when we came back in. You got 2 places to do it: when you come back in or when you take out unchanged. Okay, questions as we're here looking at this. Julia.
Yes, I'm here. Hold on one second. Okay.
Go ahead.
Can someone who doesn't know anything about options trade absorb what you're going to teach in the options course?
It will be difficult. It will be. You don't have. You're better off if you don't know the Greeks about options. But it's still. It is not a child's game. It is not a child's game because trying to buy and sell these options, you can't do it at the market. You have to follow the bid and ask, and sometimes and you cannot put a market order in, generally not put a market order in. And I will sometimes if it's the shortest term option and I really need to get in or out. It is, if you haven't any familiarization with options, I would not attempt to pick it up, at least initially. What I would do, the first step I would do is I would start to put them up on my screen, and so start to look at them so you get a feel of how they trade. There's only experience is going to give you some idea of how they trade and how the volatility increases and decreases the price very quickly. It is not a child's game at all. It is something that I get requests for. It is a very dangerous. Most people can't handle the volatility. I'm going to show it just simply for people that have a little more experience in it. But we will talk more about that as we go. But no, it's not easy by any stretch of the imagination, and it adds a whole different level of emotion to what's going on in the market, and you have to move fairly quickly sometimes.
Okay, great. Jim, can we?
It's a good question. Okay.
Thank you. Yes.
Right now, we're continuing to head lower. We're continuing to head lower. We bounced back up to the point of control. They tried a little lift, didn't get much. So now we're coming back down. As I said, the destination trade becomes the overnight low and Wednesdays and Friday's low. Right now, it's single prints. The sellers are in control at this point in time on a short-term basis. We're still within balance. I don't see any reason to have come out. If you did a short when we came back within the range and down below unchanged, I don't see any reason to get out of it. If I was short, I probably would have lightened up just a little bit. This is another thing. This is again, if you're going to shorten up, it's an individual choice. This is an awful lot of single prints to remain in a market that is not a high confidence market. It may turn out to be that way, but it's unlikely that if you're going to get this many single prints and they're going to hold, more than likely you would have had more confidence right off of the opening, more selling directly off the opening. The fact that we opened, went higher, then came down already tells me that this is not the highest confidence environment that I could be in. That doesn't mean we're not going lower, but when I'm talking about confidence, it's not the highest confidence because we opened, we went higher, we came down, we went higher, we came down. We did that several times. Then after it got through unchanged, the short-term traders came in and started selling the market. So more than likely what we're looking at right here are short-term and day time frame sellers rather than an indication that we've got some real solid selling from serious longer-term players.
And
okay?
Yes, and someone's mentioning Chicago PMI came in much weaker than expected. And that was, oh, actually, he must get the news early because I only have 944. I think that's a 45 report. 40. So I know you don't pay attention to reports, but
let me make a comment. Let me make a comment right now. This is for those that are new to us. I will recommend that you do not read the news reports. It is probably the fastest way to get cognitive dissonance that you can imagine. I understand it's very hard for you not to do that, and it's very hard not to listen to somebody talking about it. But if you think this market has basically rallied from the last jobs report, and the last jobs report was negative, you
do tell people to clarify, excuse me, Jim, they need to know when reports are coming out. They should be aware. And just not looking at the number, look at what the market, how the market responds to that.
To the report. That's exactly right.
Yeah.
You should know what time it is coming. And then you watch to see how the market responds to it, rather than knowing what the number was. One of our best clients ever came off of the floor of the New York Merc. It was an oil trader. And they were all accustomed to, everybody focused on when the numbers were coming out. And I made this statement, and he said, you are absolutely right. He said, most of these guys, they live, eat, slide, and die by the numbers, thinking that they can trade the numbers. He said, I'm only looking and see what is the, he said he's with me 100%. He's only interested in what the market does afterwards. Knowing what the number was will do nothing but cloud your mind. It is very dangerous. And I can say that over and over again, and I'll tell you, if there's one person out of 500 that will not look at those numbers, it's a miracle. But I can promise you, you are better off not knowing what the number was. Okay,
Jim,
so
okay.
Go ahead.
Jim is trading the S&P futures options, not the SPY options. If Jim were trading the SPY options, he wouldn't be doing it against futures, so you'd keep it in the same market with hedging and option trades, correct, Jim?
Absolutely.
And the second question we have here is, what is tempo, and can we see it here? And it's a slow tempo. It got down below the point of control. It was trying very hard to get down lower, and the tempo was slowing. It wasn't
Tempo,
moving.
it's just like in music. When I said early on this morning, the market opened, it went through unchanged, and it went up. The tempo was slow. It came back down. It went back up. The tempo was slow on there. It's something, and that is, again, something that you only gain an understanding of through experience. And, you know, I bring up the term confidence. There's a lot of these pieces that have to come together to make it all work for you. You saw Friday. You saw when I walked through Friday. That wasn't easy on Friday. I was wanting to sell the market 2 in the morning. It took tremendous discipline for me not to sell the market on Friday. I could see it was going lower. I can see they're going to take the low out. I was pretty sure of that. And yet I said the better trade is going to be a counter trade, because the move down is in relation to overnight inventory, and the market's actually getting trapped on the short side in the process. It was very difficult for me not to do that. But then the market gave me the trade that I really wanted later on, the trade that I saw developing from the opening. And It takes a long time for you to be able to put those pieces together and, you know, kind of have that symphony of how do you trade the market. It is not easy, but remember, the majority of people do not master trading because it is complex. But what we're doing is showing you the things you ought to be looking at. Okay, Julie, I hear your lips moving.
Yes. This kind of goes hand in glove with the tempo question. What do you look for to keep in the short trade? He was in the last intensive. I believe he's short at the look above and back in because of the low confidence. Do you just look at your profits? He's, you know, obviously he's feeling the low confidence. The tempo, it's not going lower. Okay.
Do not look at your profit. That has absolutely nothing to do with it, and that is a killer. What happens to most traders, and you've heard this so many times, they are quick to get out of their profits because it feels so good for a very short period of time, but yet they let their losses run, wishful thinking. So we talked about this morning, okay? When I'm looking, this is not a high confidence market. Would I be out of some of my shorts up here? I may have cut them back a little bit, simply because of the fact that I'm saying this wasn't high confidence from early on, and this was all white early. Now look, now what's happened? We've gained some volume. Now it's a continuous two-way auction process. We've picked up some volume in here, so we're getting a little bit more aggressive on the short side of the market. And now we're going to change. We've got 11 minutes. I'm saying would be unlikely, not impossible, be unlikely to hold all of these single prints. So you may it may hold them. Who knows? I mean, this is the reports are coming in from weekend sales. Now they're going to be talking about Cyber Monday, you know, and everything else. The pressure right now is to the downside, but I think the odds are low that we hold all of these single prints for the remainder of the day. That doesn't mean we won't. I just think the odds are low that we do. So I would think if you were short this morning, I would think that you probably would have wanted to lighten up a little bit, but you may then be looking to sell rallies.
Mm-hmm. Okay, great, Jim.
The biggest, well, Julie's looking at other questions. The biggest piece of information this morning was monitoring and understanding what was going on at the unchanged level relative to Friday. That was the piece of information that, it took a little patience to watch it, but you saw it early. Look below it, came through it, and we came 4 or 5 times down to a single tick above it. And that information to me right now, the first thing I knew when that happened, at that point in time, I would not be long even if the market went higher. It tells me that it's mechanical, it's weak hands buying. If people will only buy if they can buy it a tick above unchanged from Friday, that is not money that's got any size behind it. So when it came back into the range or back through that to me was the short. That was the biggest piece of information I have seen so far this morning. So what happened around unchanged relative to Friday was the biggest piece of information. Second biggest piece was failing above Friday's high. Third piece of information was getting back to the prominent point of control from Friday, which always is a reference that we use. And then the next thing I'm looking at, and this may not turn out to be true, but I'm looking down and I'm saying, this appears to me to be too many single prints to hold for the remainder of the session. Doesn't mean it won't, but it just appears to me to be too many single prints. Right now, I think we're getting liquidation, probably from some people that were long on Friday, and probably from some people that bought automatically this morning, because what I wrote in the report or what I said was there's people that were going to buy the market this morning automatically because, oh, wow, I don't have to think about it. This is the start of the Santa Claus rally.
Okay.
The statistics say that, it starts so often the day after Thanksgiving. Well, if that's what they did, and they may have been buying it coming in the opening, now they're being forced out. Okay.
Do you look at other markets along with the S&P mini, like the Russell and the NASDAQ?
That goes back. That question goes back and forth. The biggest thing that hurts traders is cognitive dissonance. And if you look at enough other markets, the chances are you're going to mess up your mind. There's enough. If what's going on in the Russell, if other people are looking at it and the NASDAQ, it's going to be built into here. So if you look at that plus what's going on here, you may actually be double counting the information. Now, with that said, okay, you'll find that I don't have a single rule I've never violated. If I'm looking at a market and I've got the Dow up for the day, or I'm sorry, I got the S&Ps up for the day and I got the NASDAQ down, I pay attention to that because the markets, where you get the biggest moves in markets and where you have all indices, all stock-related indices moving, about the same percentage directionally. When you've got some moving down and some moving up, that takes, you just say that the whole world isn't negative. When the markets really go down big, when the whole world is negative or the whole world is positive. So, I'm aware of that, but no, I try not to trade it off another market. However, that doesn't, off another indices from stocks. However, that doesn't mean that, sometimes it's just so obvious that there's nothing else going on in the market and they're trading it off of crude oil. But you don't have to look to crude to see that. You'll still see it in this market. But, when there's no real confidence in the market, you don't know what traders pick up to trade off of. It's a lot of what they do sometimes is nonsensical in here. Mm-hmm. But there's a lot of information in the market that you're trading. And incidentally, we put these up before the SPY and the S&Ps will look almost identical. So it doesn't make a lot of difference to me which one you trade. I think the SPY is probably more attractive for a lot of people because there's less leverage involved. And I think an awful lot of problems come from people that are over levered using futures. Okay, now we've got 5 minutes. We've got 5 minutes until the time change.
Okay.
Early on, I said I thought the odds were, to me, there were too many single prints to hold throughout the entire 30-minute period. Now, that puts pressure on somebody that's short. Well, I'm probably, if I'm short, and I'm still 100% short, if I was, that means I'm probably going to have to take some heat. So, if I made a decision I make. I said, okay, I'm willing to take that heat. Or I may say, okay, if I'm short, I've lightened up a little bit. But when I look at this and I look at the confidence overall, that it's not one of those days that is a free-for-all, at least not at this point in time. So
And
we are, for all practical purposes, we are still within Friday's range. Yes, we look above it and fail. Yes, we did. But we're still within basically the same range we traded Friday. We're basically in the same range we'd been in from a week ago Friday, Monday, Tuesday, Wednesday. So there's no real signs of change so far in this market. Yeah, did we look above Friday's high? Did we come back in? Yes, we did.
okay.
Did we get near 2100 level? No, we didn't. Did we, we got above 1, 2, 3 highs. We didn't get above these, and that wasn't a very good high. But right now the pressure is to the downside as we open on Monday morning.
Okay. And
Now I am going to look. Hold on here. I'm going to take a look at overall volume this morning. We go to our training site. And New York Stock Exchange volume is 341 so far.
which is light.
341, and we've got 3 minutes till we change periods. That is exceptionally light volume. About minimal volume for the first half hour is about 380. If you've got anything really big going on, you're going to be in the 400, 500, maybe even 600 range. So more than likely, we'll look at that volume at 341 with 3 minutes to go. I'm getting some liquidation. I said I thought inventory was probably long from Friday, not big long, but a little bit long. So right now, I've had some liquidation, but I don't see any indication that I've had, at least at this point, any serious selling coming in.
Okay.
Anytime you look above Friday's high, the destination trade before the day is over becomes Friday's low. That's the destination trade. Now, the question earlier, do I look at value? Yes, I do. Remember, this 2087.50, no, I'm sorry. It's right there. Well, we have to change these colors. 2086.50 is the low of Friday's volume, a value area. So now, what I want to see, if we're going to get a lot more on the downside, I want to pretty well spend time below the low of Friday's value area, 2086.50. So I want to see more acceptance down here, and I want to stay down here, and it takes time to pull value lower. If we only traded this low, and that was the low for the day, more than likely value is going to be unchanged to overlapping to higher before the day is over. If we spend time down here, then the odds are very good that value stays lower and becomes at least lower or overlapping to lower for the day. Okay. So we're going to go ahead. I'm sorry.
The colors, everyone, very quickly. The red is high volume, the pink is medium volume, the white is light volume. We more focus on the colors in the text figures, and I use histogram. Jim usually does. His has the wrong template up, but just focus on the volume. You'll notice here we have almost 12,000 contracts. It's gone below the 12,000 contracts at, what is it, 2085.75 area, right? Okay,
Yes.
so we have to see, is that new sellers, or more sellers coming in, or is that, people buying and they don't get exact prices when they have size to put on. So we'll see if the market is going to escape that high volume, or in fact, they're running and gunning for the overnight low now, it seems to me. Jim always says trading is a game. So we'll continue to monitor it. But someone asked a question, Jim, about the single prints. He's saying, how can it be too many single prints? Look at this here. B starts printing. Think of a profile that opened in range, not a trend day. How many times do you envision a profile going lower from here and holding all those single prints? Look across your profiles. Do you see it? The question is not very likely. On a trend day, sure, when we're gapping out of range. But this type of day, that's what Jim means when he says there's a lot of single prints in A period. Now, so we're looking for those to be revisited in the next period or at some point. And we keep that in our mind's eye as we're watching trade and the profile develop. Okay, Jim.
Okay, as Julia pointed out, this high volume came in. I'm going to take some of these other references out of here for now. Okay, Julia mentioned the volume at 2085.75. That was the first biggest volume we saw come in. And that, if there's anything there, I really don't, if I'm short, I don't want to be back above that number. Because at that point, as Julia said, we don't know at that point in time if that was buying or selling. If it was buying, the market may still go down a little bit earlier, a little bit more, because what happens if I'm trying to buy size, I will try and lead the market. It's like shooting ducks. I will try and lead the market. So I don't, but I mean, it could have been selling. We don't know that. Sometimes lower prices will bring in more selling. Sometimes they cut it off. But that is my reference right now. If I am short, I'm going to have my stops just a couple of ticks above this high volume number, 2085.75. I'll have my stops just a couple of ticks above that. Because I don't, if this is any good, I don't want to go back through that number.
And
okay. So
we also
now,
have the overnight low, Jim. I mean, trading is a game. We're getting in striking distance. It's not, I wouldn't want to step in and buy this right here personally because, you just want to let this thing play out. It would be very easy for them to go and get the stops below the overnight low, and it's so close to Friday's low. I'm not saying it's going to do that, but you might want to sit tight and just make sure this thing is done before you step in and fade it. But go ahead. Do you want to say? Go ahead.
And that's an issue everybody has to deal with individually. As I said earlier, the tempo coming down seems to me agonizingly slow. The volume was low coming down, and so I'm a little. And that's a lot of single prints. Might it go lower? Might they get the overnight low? May they get Friday's low?
Just to see what level at it.
Okay. Might they get that? Yes. But as I've said, this appears to me to be, from an odd standpoint, everybody wants absolutes. If I sit here and say, I think there's too many single prints, and we don't take them out, people say, oh, well, I knew he was wrong. And remember, odds are just that. They're not absolutes. If I'm trading, I have to consciously make these decisions about risk control. And my decision about risk control is this was too many single prints relative to the lack of confidence that I see in today. So I'm saying, from my standpoint, I think they're going to take some of these. I think the odds are they'll take some of these back. So if I cover my shorts, or I cover some of them, and it takes this out, so what? So I missed an opportunity. I miss opportunities all the time. Trading is about making reasonable assessments about odds. My assessment right now, and it hasn't happened, is that it's unlikely we're going to keep all of these single prints for the day. I mean, I've been saying that early on. We may keep them, and you'll say, well, I didn't need him. Look at all those single prints. I knew we were going lower. So, but, and I'm wrong all the time. I'm wrong all the time. But it's reading the flow. It's reading what's going on in the marketplace. Now we've got another reference. We've got the high volume reference up here at the 2085.75. And one of the things I said, I don't want to go back above that if I'm short. Okay, and a couple last questions.
Yeah, and just to comment here, like it's trying awfully hard to go lower, and it's just the tempo and the directional conviction, the ability to push this thing lower. You can see it struggling. It went back to that high volume node print at 85.75. It came off of it, but you just start thinking, how did it get to a reference? And Jim really focuses to get us to start thinking with our own market logic. And you can see it is difficult to fade it right here because we can't be sure it's done. Sometimes the laggards and the final laggard sellers step in, the final laggard buyers that can't take the pain anymore, they liquidate, and you get this little whoosh down, I mean, in a technical term, it would be volume climax. So could they get there? I mean, we're just carrying forward right now that it's trying awfully hard, and those single prints, I mean, I don't think they look too good for the day. This is a low confidence day. It's not like a trend day. Very unusual to see a profile hold that many prints by the end of the day. So it's just a matter of being patient. Or if you're really aggressive, you step in and buy it here, but you have a tight stop. Or you may have to wait until the overnight low and the pit low. That might have to be your stop. Jim taught us or teaches, you know, where do you put your stop? I mean, you could step in and buy it here, but where do you know you're wrong and the trade is busted? It's pretty far away depending on what your risk tolerance is. So anyway, it is struggling, and I do think we're going to be seeing the upper end of the range. It's just a matter of what is your appetite for risk,
But we don't know
and
if we
what is
see
your
the upper end.
aggressive, how
We
aggressive
don't
are
know
you?
if we see the upper end of the range, but keep in mind,
Well, if
it's
single
a
prints fill in, yeah.
filling on some of the same, but keep in mind, it's a continuous two-way auction process. And when you're doing the shorter the trades you're making, you're watching each one of those auctions to see what is behind it.
Mm-hmm.
So right now, this when we get down near the overnight low, near Friday's low, this becomes the high risk area. This is the higher risk area down here. Would they like to get this? Oh yeah. And if we got this, if we got through the overnight low, we'd probably take the daytime Friday's low, and we'd probably see some acceleration for a while, because that'll, there'll be stops there and there'll traders come in. But right now we're 36 minutes into the day. We've got a lot of single prints. They're trying awfully hard down here. They may or may not get it. I don't know, but it's certainly not a high confidence day to the downside, not at this point. But you can say, but wait a minute. We looked above Friday's high, yes. We have all these single prints, means there's some aggressive selling, yes. The destination trade, when you look above the high and fail, the destination trade is the opposite extreme. And right now they haven't given up on the downside.
No,
but
they haven't.
they're not. You're just feeling how much work they're doing. And I'm sitting there saying, if they get it, so what? The odds of remaining short in here without a rally first appear to me to be very high. And I've been saying that for a long time. We don't know what's going to happen.
Appear to be high? The odds of remaining going lower? I'm sorry.
The odds of remaining lower, going lower from here, appear to me to be low.
Okay.
The odds of getting a rally, because the tempo coming down here and too many single prints, appear to me to be high.
Yes.
This appears to me that the market's getting too short on a day time frame basis. All right, let me take one more question, one or two if you got, whatever you've got there, Julia.
Can this 12K volume reference be used as a look above and fail, as well as for a trade to the overnight low? Not necessarily, but go ahead, Jim. I don't know. We don't necessarily speed that up like that.
I think you can look too hard for these references.
Yeah.
But that is the reference, because what we don't know, here's what's going through my head. If that was selling volume, if this was real selling at that volume,
wouldn't be coming back.
The odds are, whoops.
Are you there? Uh-oh. Hold on, let me see if Jim, he's still here. Okay, Jim, we'll hang out. We'll wait. I don't know what happened. Yeah, Jim got knocked out. Just give us a second. Hold on a second.